Hello, my name is Neil Shah and I will be explaining why I think Johnson & Johnson will outperform. Johnson & Johnson is an American multinational company manufacturing medical devices, pharmaceuticals such as Remicade, and consumer packaged goods like the well-known baby product. Although we may know Johnson & Johnson through their products sold at local retail stores, their main income streams are from medical devices and pharmaceutical sales. As you can see, the revenue has steadily been increasing along with their share price over the years. Credit Suisse Holt team has also identified biotech to be an up-and-coming sector, and with Johnson & Johnson promoting products such as these, it should be on its way up. Johnson & Johnson is generating economic wealth as the CFROI has been consistently above the discount rate. Notice that when CFROI was improving, margins were also improving along with sales growth due to their strong dent in the market and through acquisitions. From 2007, we saw asset turns and therefore sales growth starting to fall, which led the CFROI to fade from 20% to 13%. Some contributing factors in this were the patent expirations and product recalls. Now that these factors and the crisis is all over, we are starting to see this steady out and bounce back as shown through asset turns and an improvement in margins, showing that management has done a good job in keeping costs down. Due to J&J's low volatility of CFROI has been forecasted to fade by only 0.61% in the next 10 years, staying well above the discount rate and market implied CFROI. Johnson & Johnson should make sure they do not overspend or take up too much leverage. Their debt-to-equity ratio is at a satisfactory level of 0.2. Management should focus on increasing asset utilization to promote further performance. Assets have been growing almost every year except from 2012. As you can see, the CFROI is correlated to stock performance, especially shown in the years 1994 to 2007, showing trust in management's ability to drive shareholders' wealth. When comparing to its peers through traditional valuation, we can see that prices for both book value and earnings are cheaper than many competitors. J&J also pays high dividends and has been increasing it for 52 consecutive years, which is extremely attractive to investors. Johnson & Johnson is under the line for the whole price to book CFROI, another signal showing us that it is undervalued. Johnson & Johnson has a warranted price of $138 and has a good margin of safety when adjusting for sensitivity in CFROI and asset growth fade. Although there are few risks, Johnson & Johnson plans to bring in 10 blockbuster drugs in the next 5 years. The rise of personalized medicine will also cause investors to flock in the future. It also has the rare but highly desired credit rating of AAA, giving us further confidence that it can meet its debt obligations. As a result, I believe Johnson & Johnson will outperform.